This is William Keegan,
This is Stephen McConville.
and we're here representing Tyler Gibney and Harley Jackson, our other analysts for CALLON Petroleum Continuing Coverage Burke and Rhodes Report.
We will be getting into our company overview, our corporate strategy, arriving at our valuation and target price, providing you with our key assumptions, and ultimately providing you with our team's recommendation and investment thesis.
CALLON Petroleum is an independent E&P company headquartered in Natchez, Mississippi, with offices in Houston, Texas, and Midland, Texas. They're a pure-play Permian operator, drilling solely out of the Midland Basin in Texas. As of November 6, 2015, some key metrics for the company are a market capitalization of $585 million, earnings per share of negative $2.09, which leads to a non-computable PE ratio.
CALLON Petroleum operates 107,605 net acres in the Midland, Upton, and Reagan counties of West Texas. CALLON Petroleum is currently running a 2 walking rig drilling program in the central acreage, which is a shift in focus from a 3 drilling rig program with 2 rigs in the central acreage and 1 rig in their southern acreage. CALLON is currently producing 78 horizontal wells, which would last the company 17 years of reserve life with 2 horizontal drilling rigs and 11 years of reserve life with 3 horizontal drilling rigs. Our team will now discuss CALLON's adjusted corporate strategy from the second quarter moving into the third quarter of 2015. As of end of Q3 2015, CALLON Petroleum has been able to renegotiate its contracts with oil field service providers for new wells under $6 million per 7,500-foot lateral wells. This increased savings is put towards enhancing completion of the new wells. These savings are also accounted for in a 40% CapEx reduction for 2016 versus 2015. The increased production growth for 2015 versus 2016 is estimated by management at approximately 20% on 2015 estimated annual production of 9,450 to 9,750 barrel of oil equivalent per day. Currently, the company has $201 million available on its $300 million borrowing base, which is an increase on the $250 million borrowing base CALLON Petroleum had at the end of second quarter 2015. One of the key goals of management is to achieve cash flow neutrality by the second half of 2016. Given the increase in renegotiations with their service providers and the continued low price environment, management believes this is a realistic target in the near future.
We will now get into our valuation and how we arrived at our target price. When deciding which companies to choose for our market comparables, we were looking for firms with operations in the Permian Basin with a heavy weight in oil. In addition to this, we looked at similar market capitalization. We decided to exclude Approach because they were much smaller in terms of their market capitalization and were not nearly as heavy in oil percentage in their operations. In addition, we decided to exclude Sanchez because they did not have any operations within the Permian Basin. We arrived upon our 12-month target price of $10 by equally weighing 3 different methods: the PV10 5-year, PV10 7-year, and price per cash flow per share method. For our price for cash flow per share, we arrived at a multiple of 7.9 due to analyst estimates from SunTrust Robinson Humphrey. A PV10 method valuation is found by taking the revenues net of direct costs and applying a 10% discount rate. We will now discuss some key assumptions of how we arrived at our target price. In our model, we assumed a 2-rig program rather than 3 due to CALLON's decision to scale down operations in the current market. We assumed 6 new wells per quarter until Q4 2024, with future well costs of $5.9 million for the next generation of 7,500-foot lateral wells. We assumed a daily production of 650 barrels of oil equivalent, with 87 cents on the dollar of the revenue sharing going to CALLON, with a product mix of 81% oil and 19% natural gas.
We will now discuss our team's recommendation on CALLON Petroleum. Our team finds a 12-month target price of $10 per share and gives CALLON Petroleum a market perform rating. As of November 6, 2015, CALLON Petroleum's shares closed at $8.83. Our $10 per share rating represents an increase of 13.25%. Our team would like to conclude our presentation with our investment thesis. Our team is confident in our $10 target price for CALLON Petroleum because they are thriving in a low-price commodity environment. However, we were very conservative in our assumptions. We expect CALLON to continue lowering its rig servicing costs while also boosting margins because of their strong business relationship with Cactus, their service provider. We also believe cash flow neutrality is obtainable since it is an explicit goal of management. While CALLON shifts its focus to the Lower Spraberry, they are looking to exploit more oil-rich fields to ensure maximum production moving forward. Our team is confident in our $10 target price for CALLON Petroleum because they are thriving in a low-price commodity environment. However, we were very conservative in our assumptions. We expect CALLON to continue lowering its rig servicing costs while also boosting margins because of their strong business relationship with Cactus, their service provider. We also believe cash flow neutrality is obtainable since it is an explicit goal of management. While CALLON shifts its focus to the Lower Spraberry, they are looking to exploit more oil-rich fields to ensure maximum production moving forward.